All right, it's 11. Thank you very much all for joining and as usual being super on time. I look forward to talking you through the launch of our second climate tech portfolio fund today. So a few announcements before we get started. Liza, if you could skip to the next slide. Yeah, so if you wish, feel free to introduce yourself in the chat with your name and role. You will have the opportunity to ask questions. So we'll try to keep it relatively short in terms of presentation, hopefully no more than 35 minutes, and really open up the floor for any kind of questions. Kindly put the questions in the Q&A section, and then we will answer some of these in the talk, and others we will answer in writing. So kindly in the Q&A. All right, then let's talk about what we're going to talk about today. So we're going to initially kick off after a very brief intro on carbon equity, on why in general we think it is interesting to invest in climate technology. And then we'd like to address the current market conditions, which have been relatively volatile, as you know. Most recently, we had the collapse of Silicon Valley Bank. The markets have been going up and down. And so we'd like to address what we're seeing and how we reflect on those dynamics. Then we will talk a little bit about how we look at the climate investing fund landscape, talk about how we select funds, both from a climate diligence point of view and a general diligence point of view. And we'll briefly talk about the launch of our latest fund, the Climate Tech Portfolio Fund, which is a fund of funds that invests in 7 to 10 underlying climate venture capital, growth, and buyout funds. All right, let's get started. So with me today is Liza Rubinstein. Liza is one of the co-founders of Carbon Equity. She is our head of impact, so she leads our impact diligence practice and thought leadership. Liza has a background at McKinsey in specifically focused on energy transition, and she is also the face of our newsletter, which I highly recommend you sign up for. And Wiebe Visser, managing director of the investment team, has had a long career in fund investing, spent over 11 years with AlpInvest, prior to that 5 years with JP Morgan. Myself, I have a background as a private equity and a VC investor and as an entrepreneur. Cool. So in a nutshell, what is carbon equity for those people who are tuning in for the first time? Carbon equity is a climate venture capital growth and buyout fund investing platform. And basically we allow you to invest in climate technologies, climate innovations, alongside top investors by enabling low minimum access to top climate venture capital growth and buyout funds. We do so with, at the moment, we started almost 2 years ago, have at the moment over 450 investors and close to 100 million of capital invested in climate technologies through carbon equity. And the main reason why people invest through carbon equity is actually four key reasons. First of all, we are one of the world's most specialized players in climate fund selection. So we have developed a proprietary climate diligence framework, which Liza will tell you more about, which helps us select the very best, most intentional climate funds in the world who can also deliver superior financial returns. We enable unique access to these funds. So typically these funds have very high capital minima, and we leverage our network, but also our reputation as a climate investor to get into these funds and deliver access to you. We enable low minimum access. Currently, the minimum starts at 100,000 euros, and in the coming months, we will hopefully launch a 50K option. And we try to enable fund-of-fund access in a as low-cost way as possible. So carbon equity allows access to unique top funds allows you to diversify your investment in the climate theme thanks to low minimum access to these top funds. We do so at low cost. And lastly, we try to make this as fun and engaging as possible, but really taking you along on an active climate investing journey. We'll talk a little bit more about the app and platform and webinars and education that we do later. But first, let's dive into the mode of this conversation. Why should you consider investing in climate technologies at all? Liza, may I hand it over to you?
Absolutely. Thanks, Jacqueline. So why invest in climate technologies? Well, first of all, I think all of you know this, but we have a problem. The world is heating up due to carbon dioxide and other greenhouse gases. If we continue as doing nothing, we might reach beyond 4 degrees average global warming. The IPCC on Monday published its new report. With all policies that we've implemented, we're still heading towards 3.2 degrees. So we need more action. And why do we need more action? That average temperature global warming isn't the biggest problem, but the biggest problem is that with that average increase, we'll get more extreme weather events, more droughts, more heat waves, more hurricanes. And on the right-hand side, for example, you see that with 4 degrees average global warming, the hottest day of the year on average will get 7 to 8 degrees hotter. So definitely something that we want to stop, and we need to get to net zero as soon as possible. How do we do that? Well, we need to transform 6 sectors. First of all, there's 5 sectors where currently a lot of emissions are coming from that we need to decarbonize as much as we can. And then there's a 6th industry that we need to build. So the industries that we need to reduce emissions as much as possible is the energy production sector, mobility, industry, how we make things, buildings, how we live, food and agriculture. And finally, the sector that we need to build is the carbon sector, where we're talking about carbon capture, whatever's coming out of exhausts, and carbon removal, the stuff that we can capture directly from the air to reduce concentrations. Well, the good news is that there's a lot of innovation underway to decarbonize all of these sectors, because we want to get to net zero, but still maintain our current living standards. And for that, we need to figure out new ways to build, to live, to move, to eat. And fortunately, there's a lot of amazing climate tech underway to do that. So what is climate tech? Climate tech are innovations that are explicitly focused on reducing greenhouse gas emissions. They can do that either by building hardware, or they can be software, or they can be a hybrid of the two. Let me share a few examples. So hardware, for example, Sunfire is one of the companies we help fund. They make the machines with which you can make hydrogen. And their machines are way superior, higher in efficiency, and thus superior in cost, and are scaling rapidly. On the other hand, the software end, for example, you have Normative. This is a company that is automating and reducing the cost of carbon accounting. Why do we need carbon accounting? Because companies need to know where their emissions are coming from, and then they need help to figure out how to reduce those. And then finally, an example of a hybrid company, Amped Energy. They make really cool containers full of batteries that you can put on site at construction sites so that you don't need those diesel generators anymore. And their technology consists of both the actual battery in the actual container, but then also a lot of software to make sure that that energy use is optimized and the grid interaction is optimized. Of these climate technologies, there's a really clear view of what set of technologies we need to build that net zero world in which we can still live the way we currently do, more or less. The challenge is that some of that technology is mature, but quite a lot of that technology still needs further innovation to get to scale and cost parity. An example of a mature technology is solar and wind power. It's already cost effective. It's actually cheaper than gray ways to produce power. We know how to produce it at scale. We're already producing it at scale. We're already deploying it at scale. There's still incremental innovation happening, but not radical anymore. 28% of the technologies that we need are in that mature state. The other 72% needs additional innovation, either in really figuring out how to go from the lab to small scale facilities at first. In the bottom, research and design, carbon negative cement is a great example there. Then there's technologies that are demonstrated, meaning they're small scale plants, but we need to figure out how to turn those into big plants effectively. Synthetic fuels, fuels that are made from electricity are a good example. And then the early adoption technologies are technologies which there's already a few alternatives in the market. We expect still that groundbreaking things will make them cheaper and easier and better. And there are heat pumps with which we can heat our homes is a good example. So how do we get that 70% plus of further innovation happening? By investing in climate tech. And the good news is that the world is really gearing up for that climate tech and that further deployment. I can't stress enough how much has happened from the government side over the last 12 months. It's really been incredible. So at present, 90%, 1% of global GDP is under a national net zero target, meaning that over 90% of GDP is committed to get to net zero. And these governments are developing the policies that we need to actually really get there. So for example, in Europe, we're banning fuel-based cars as of 2035, potentially still going to 2030. And with that, electric vehicles are really taking off. But we're also banning the way that we heat our homes with gas and other technologies, and trying to create all the policies required to further get to net zero. And now the latest trend over the last year is that we also really see governments putting in the money that we need to get those innovative technologies to scale. The USA really led the way with the Inflation Reduction Act, the IRA. It's a policy that they say it's going to cost $370 billion, but there's no cap to the tax credits and subsidies that they're offering. So some people think it might even get to $1 trillion in funding of a whole range of climate technologies, including hydrogen, solar, electric vehicles, whatnot. Now, the big caveat or the big, let's say, step change of that IRA is that that subsidy only applies to technologies that are partially or fully produced in the United States. And so they're trying to create a competitive advantage for green technology in the US. Well, what does that mean? That means that other countries must follow. China and Japan have already done so, also with 100 billion plus subsidy scheme each, and the EU is in full process of doing the same. And with that, trillions of capital are fueling or moving to innovative climate tech. Then corporates are incredibly important for this new landscape that's emerging. 49% of large EU corporates have already committed to 1.5 degrees global warming. Now, they've actually implemented and designed those transition pathways in varying degrees, but at least half of them are publicly committed to 1.5 degrees, and they're following with their dollars. So there's a huge amount of M&A activity happening from corporates that are buying those climate technologies to actually get to net zero, because to transform, they need new technologies, and they typically obtain those by buying up companies. So for example, of the nearly 300 climate tech exits that happened over the last decade, 63% of those went to corporates. So the dollars are there for the exits. Then the consumers are increasingly motivated and willing to pay for green stuff. Millennials, by now, 90% of them say that they're willing to pay a green premium of 10%, meaning they're willing to pay 10% more for something green. And to put that into comparison, 2 years ago, that was 32%. So really consumer awareness and drive is coming. And finally, the financial sector is starting to move with all of this. So by now, 40% of the financial sector has committed also to net zero. And that means that they're supporting, or they're trying to do 4 things. One of those 4 is also increasingly invest in solutions in climate tech. And we see the big dollars that are ready for those more mature technologies to scale further. So in all of these macro trends that are all pointing towards net zero, we see huge new markets developing. And just to give you a few examples, the green hydrogen market right now is 300 million, but it's expected to grow by 33 times to 10 billion in the next 10 years. Heat pumps, already a much bigger market, 29 billion, still expected to double in the next decade. Meat replacements, 9 billion, pretty good market, but growing to 290 billion. And also renewables, where we think, how much further can we go? Well, we can go a lot further, we need to go a lot further. And that market is also expected to double in the next decade. So that's the high level story. But then the big question is, why now? Because it's quite a tricky economic market. There's a lot happening, but Wiebe will take us through why now might actually be a great time to invest in climate tech.
Yes, thank you, Liza. Good morning, everyone. Liza did a great job explaining why climate tech, in our opinion, is one of the most exciting investment opportunities for the decade to come. But why now? And that's a relevant question, because if you look at the financial markets since the pandemic, we've seen that supply chains have seen a lot of constraints. There were labor shortages, geopolitical events like the invasion of Ukraine by Russia, all resulted in soaring inflation. And the inflation was followed by rising interest rates in an effort to curb the inflation. And that resulted in some regional banks struggling as of late. All in all, clearly a slowdown in markets, the valuation of technology stocks decreasing, and also the public markets for new publicly listings has been shut. So against that backdrop, though, if you look at climate tech, in 2022, it continued to grow. So the absolute amount of dollars that went into climate technologies in private markets grew from 2021 to 2022. And also the percentage of the overall private equity and venture capital market that went into climate-related investments increased in the past 5 years from 6% to 12%. So very resilient, especially if you compare it to the wider private equity market. So whereas climate investments continue to grow over 6% last year, the overall private equity market declined by more than 24%. And this is really recent data that McKinsey published this month. So clearly structurally attractive. However, the market is shifting. So if you look at the valuations, also in climate technology, the valuations have come down. There's just more careful, considerate investing going on, less driven by FOMO, more focused on fundamentals, and really focused on profitable growth. So what you see is the rounds tend to take a little bit longer for companies to raise capital. Investors really taking more time to dig into technologies and betting, making more considerate, careful bets. I think that's a good development, not necessarily bad. However, another side effect of increased interest rates, and we've all seen it in the past couple of weeks, is that banks such as Silicon Valley Bank have been struggling as a result. And not necessarily an effect because of the climate market where they had huge exposure. It was really a mismanagement of the bank's balance sheet. However, SVB was the key bank for the climate investment space. So what are some of the concerns here? And we've been looking into this in the past couple of weeks. I think one of the fears that we had initially was, okay, will this dry up funding? Because SVB provided a lot of project finance, fund finance, but also venture debt. So will that fall away, and how is it going to impact the space? Now, the good thing is they were definitely not the only bank. There are 4 or 5 other banks that in each of the, let's say, the term sheets that were negotiated were present. They were just not as aggressive as SVB. So the good thing is there are definitely other banks out there, slightly more expensive potentially, but it's not binary. It's not that the capital is not there. It's just other banks that will now step into the shoes of SVB. There might actually be a silver lining to SVB falling away. It will result in a continuous careful selection of investment managers in the type of investments they're making. And I think from a new investment point of view, that's a good thing. And potentially could also result in a different policy by the Fed. And we will learn more later today. Maybe they will ease the interest rate hikes going forward a little. And if they do that, that's a good thing for technologies, right? So there's a good thing for the market and for equity markets in general, but especially for technology-driven companies like climate tech. Now, it's not the first time that we see markets fluctuations and volatility like this one. It's somewhat similar, not totally similar, but if you see similar dynamics as in 2008, 2009, after the global financial crisis. And what the lessons there are that especially the funds that were raised well before the global financial crisis, they suffered the most. They had already a lot of capital invested, and those portfolios really were hurt from a valuation point of view. And the returns of those funds that were raised in 2005, 2006, those returns really dropped during the global financial crisis. However, the funds that were raised in 2008 and onwards actually outperformed. They had still a lot of capital that was not deployed, so they invested once the market had come down. And overall, the returns of those funds have been pretty stellar. So we don't exactly know if 2023 is the equivalent of 2008 or 2009, but it's clearly that this is more a buyer's market, and investing now is better than investing 2 years ago from a financial return point of view. And even though we don't know if it's 08, 09, or 10, the one thing that's really crucial is in private market investing that you continue to invest over the years. Missing out at times like these, really, you miss out on the best years. That's proven, that's a fact. And professional investors get that. They have been more careful in 2021 and 2022. They are now, and we see that also in the engagement that we have so far for this fund, they are now stepping in. They recognize this is the time to deploy. Retail investors, private investors, unfortunately, tend to do the same, to do the opposite, excuse me. They invest when the headlines are very positive and the markets are at all-time highs. And then at the moment market tank, they panic and they start selling instead of deploying. So the one advice I would have is keep investing year over year, and this could actually be a fantastic vintage.
Wiebe, one question I'd like to entertain from the question that we received in advance. The question is, from my professional experience about this market, I see a rising shortage of good ideas, new innovations compared to the amount of money the market can digest. Is there a risk of valuations blowing up because too much capital is seeking a limited number of climate opportunities? What's your view?
Well, that's a good question. I think in general, trillions are needed for climate. So it's unlikely that the overall climate technology market will be overheated because there's so much more capital needed to scale these businesses. What we have seen, especially in the past, let's say 18 months, is that certain niches within the industry became overheated because it was easy to understand and a lot of capital went into it. For example, vertical farming at a certain moment in time got very popular, or alternative proteins, also very popular. And there the rounds went up. FOMO was the biggest driver for a lot of investors. And there you see valuations now coming down steeply. But I think in general, there are still so much opportunities out there and so much technologies that need scaling, that it's really more a buyer's market than a seller's market, and therefore valuations are becoming more attractive than 18 months ago.
Cool, thank you.
Great, so we have explained why the next decade is attractive for climate, and why now is a good time. So let me now walk you through a little bit more the fund landscape that we're looking at and some of the trends that we're seeing there. But first, let me define what type of funds are really in scope for us. We focus on funds that at least have more than 50% focus on decarbonization. Not all funds are 100% decarbonization focused, especially in the food and agri space. They have broader investment themes like biodiversity or circularity or clean water. However, for us to look at a fund even, it needs to be at least 50% GHG focus. Now, from a structure point of view, we map the markets for closed-end funds and for evergreens, but we will not focus on accelerators or very early stage funds. That's outside of the scope, and we're not focusing on that. We're also not philanthropic capital, so we really focus on maximizing impact, but we think it can go hand in hand with maximizing financial returns. And then lastly, what we do not focus on, and it's good to understand, we don't focus on real assets. So no forestry, no oceans, and no infrastructure funds. Then we do segment the markets. We segment the funds based on what they focus on, which vertical they focus on. Generalist funds, they cover the entire market space, and you have specialist funds that target each of the different industry verticals. And we also segment the market based on the stage that they focus on. Some funds really focus on new technologies that you just spun out from universities. It's really seed investing all the way up to growth equity and large buyout. And that is part of the entire scope that we focus on. And to give you a sense how big that market is, if you look at Europe alone, we have identified 140 funds that really fit these criteria. And out of those 140, we tend to select for Europe approximately 2 to 3 funds. So there's a lot to choose from. Many funds out there, and that's the way we like it. We like to be able to select the best funds out of a large universe. So let me give you some trends of what we're seeing here. There are actually quite a large number of first-time teams in this market, and I've been investing in funds for a long period of time. The bar to invest in first-time teams is high. There's higher risk involved when investing in first-time teams. But luckily, there are also a lot of emerging managers who already have raised prior funds and have some lessons learned. So that's a good thing. And if you look at the focus area, the majority of funds are really focusing on climate mitigation. Some funds, like you see in the prior slide, have a slightly broader mandate, also focus on adaptation or broader environmental strategies. Now, if you look at So if you look at the funds by sector, there are a lot of generalist funds. We do see more and more specialists popping up, but it's a different qualification. So, for example, a fund that invests in heat pumps for buildings, you could argue, is that an energy fund, or you could argue, is that a built environment fund? We tend to classify those as generalists. So therefore, the amount of generalist funds is fairly high. And if you look at by investment stage, the vast number of funds is really focused on earlier stage. But now you see more and more growth funds popping up as well, with larger players now stepping into the market. So over time, we do think that growth and buyout will become a larger slice of the overall market. Now, how do we select funds? I think that's the next step. And Liza will explain how we do it. And thereafter, I'll introduce you the fund that we are raising ourselves.
Great. Well, let's keep it a bit high level, but we do want to give you some insight into how do we select funds. So Wiebe just mentioned 140 funds in Europe. If you take our full focus, which is Europe and North America, this year we got to 303 climate, PE, and VC funds that are raising over the next 18 months. So that's where our funnel starts. Of those funds, we take 4 steps to get to investment committee and approve funds. First of all, of those 303 funds, we take a look, right? So we see, we ask for an introductory presentation. We talk to other people in the industry to get a first sense of how interesting, how relevant, how good can this fund be. If we get a little bit excited, we do an intro call. And then if we're still excited, we'll do a quick scan, where we spend a few hours really diving deep on all aspects of a fund that we think are relevant, see whether it's worth continuing on. About half of those funds we actually take to the next step. And this is where we become an impact first investor, where first we do the full climate impact due diligence. And only if we're really excited and a fund meets our high bars, we continue on to financial due diligence, where we also still do an ESG and SFDR check. And finally, we get to investment committee. So last year we selected 8 funds. Every year we expect to select between 7 and 10, which is also about the number that will land in this portfolio fund. Let us give you a little bit more insight in what it is we actually select on. So what I think is critical to understand in our way of selecting is that We really think it starts with having a clear view on what we think is a great investment in a climate technology, and then we apply that view to how we select funds. So what do we think is a great climate technology? We really take the long-term view. We're looking for those technologies that can be have a meaningful contribution to that net zero economy that we're trying to build. So when do we think that is? When a company meets 4 characteristics. So first of all, we'd like to see that a company solves a real emissions problem. And to give you an example there, decarbonizing concrete is a big problem because concrete is about 6% of global emissions. So any kind of technology that can make a dent there is solving a real emissions problem. Whereas, let's take plastic bags, which is something that for a few years got a lot of attention. Plastic bags are a big problem. Well, first of all, they're made from oil, but second of all, they end up in oceans and create pollution. But in terms of the carbon footprint, it's really quite tiny. So maybe not as big of a climate change problem to solve. So really, is it solving a climate change problem? Secondly, is the technology net zero aligned? Is it good enough to really build that net zero economy? And there we want to see that the technology either really hits those numbers of what we need per technology. Sometimes that is 0, right? So we can produce at least electricity at near 0 electricity. Sometimes it's harder. Plastic recycling, the best efficiency we can get is 60%, but then we compensate that with carbon removal. But the question is the technology net zero aligned? And then third, is it the best system solution? Because trying to get to net zero, we're trying to build a system, a global economy that's net zero. Sometimes we see technology that on a micro scale makes a lot of sense. For example, they're making biogas from agricultural waste, and then they turn that biogas into electricity, which is a way to produce green electricity. But then biogas is a really scarce resource. And electricity, green electricity, is quite easy to make. So we actually want to make electricity from solar and wind, and then use that biogas to decarbonize hard to decarbonize industries like aviation or high temperature industry processes. And finally, we want to see that a climate technology does no significant harm, meaning that even though it's optimizing for getting to net zero as soon as possible, it doesn't create harm in the process. So this is how we look at every single company and how we get excited. And then this is the lens that we apply to the portfolio of funds, but also in our conversations with fund managers to see if they take that similar long-term net zero systemic view of the transition, because we think that's how they will pick the best technologies, both in terms of impact and in terms of return. Because if we're really reaching that net zero world, a technology that's not playing a meaningful role will also not be a financial winner. This lens is applied first in the quick scan, but I won't go into that right now, but then also in the full climate due diligence. It's a framework that we developed in-house. In total, there's 40 questions that are ranked along 12 topics, and in total it's 6 themes. And we really apply that full scorecard to every fund to make sure that they've integrated impact in every step of the process, and they're optimizing for impact as much as they're optimizing for financial return. To give you a sense of maybe just of the 6 themes, so you know what we're looking at. First of all, it's about the mandate. Is that fund really in how it's committed or in how it's talking about what it wants to achieve, what it will invest in? Is it putting decarbonization first? So will it only invest in decarbonization, or at least have a clear share of capital going towards decarbonization? And then is there a clear view on what is enough impact per investment? Secondly, we look at the organization. There we think 2 things are important. First of all, that the climate expertise is there, that the people that are managing this capital really understand that broader transition and can position different technologies within it. But then also in the organization, that someone is really responsible for that impact strategy. It's continuously testing, are we really achieving what we want with that strategy, or can we improve further? The investment selection is the biggest bucket, but that's because we think it's so critical. In the end, it's all about funding the right technologies. So is this fund geared for finding and selecting those best climate technologies? Which starts with sourcing. Have they set out their way that they're looking for deals in a way where impact is head center? And then in their impact due diligence, do they try to quantify that impact potential? Typically, these are early stage companies. Their impact will be in the future when they scale, but estimating how big that impact will be and using that to say, is that enough or not, we think is really important. Also, the broader impact diligence, where not only they quantify that potential, but they take that broader view. Is it net zero aligned? Is it a best system solution? And finally, deal selection, that there is a clear and structured process with which all of that information is integrated into the decision. Impact management and reporting are both things that we've seen already from the sustainable investing and the responsible investing practices. It's a little bit older. For us, it's kind of an obvious thing to do, but not as important. First, you want to select the best companies, and then you do want to make sure that they're also getting the support they need to maintain or further improve their impact. And we also like to see that they report well on that impact. Then finally, I think what's really important for us is the actions so far, where we look at two things. First of all, we look at the fund manager. Are they really intrinsically motivated to making this transition happening, to invest in the best technologies? And are they interacting in the sector to make sure that they stay up to date on best practices? And finally, in the actions so far, we dive deep on their past investments, their current pipeline, sometimes the first investments they've done from funds, to see is the proof in the pudding. Are these funds actually investing in those companies that we think need to get funded? After we pass this, a fund passes this test where we score on every single item on a scale of 1 to 5. A 5 is a global best practice. A 3 is what we've spent a lot of time defining for ourselves what we think is good enough. And only if a fund scores at least a 3 will we consider. If a fund scores between a 3 and a 3.5, we have a serious internal conversation. Do we really think this is good enough? Typically above a 3.5, we're quite excited, all of us. And then if we are, we continue to general diligence.
Yes, so like I said, so we're not concessionary capital, right? So we're impact first, but we also want to make sure that the financial returns stack up. So once we're comfortable with the full impact side of a fund, we'll do full diligence on all the other aspects that you will see. So for example, team, very important. What's the relevant prior experience of the team? Do they have a strong track record? And is the team composition balanced? On the organization, is it a professionally run firm? Is it institutionalized? Do they have a high quality of network and advisors? All things that we'll drill down into after the impact diligence. Also, we'll focus on investment strategy, more from a sourcing point of view. How is it set up? Is it a coherent strategy? Did they apply the same strategy in prior funds? Is there no strategy shift in going on? And then finally, we drill down on the fund terms as well. Is the fund size suitable for the opportunity? Is the investment team well aligned with investors? Do they invest themselves? Very important. And of course, what are the fees and expenses for each of those funds? But let's move on now to why we're all here today, introducing Portfolio Fund II. So it's officially called Climate Tech Portfolio Fund II, and it's very much a continuation of our strategy of Fund I. So we have a target of 75 million that we want to raise this year. And like Liza said, we aim to commit that 75 million in 7 to 10 funds over the next 12 to 18 months across venture capital, growth and buyout, targeting all climate sectors with the main focus on Europe and America. So some of the terms, it's a 12-year fund life with fees ranging from 0.3 to 0.85%, depending on the size of your ticket. And I do want to address that first closers can get a 10 basis points discount. There are no performance fees, so no carried interest charged by us. And overall, what we try to achieve is to achieve a financial return of at least 2 times, so 2 to 2.5 times the money deployed we aim to return. With that, you get a portfolio of at least 150 underlying climate technologies globally. And we do that by selecting the top 5% of the funds in this space. So it's a highly diversified portfolio. So let's spend a bit of time on how we build that portfolio up. So we do that carefully. Diversification is really our friend, and we really want to make sure that we cover the entire market. So from a stage point of view, we expect that 1 to 3 of the fund commitments will go in earlier stage funds, so seed capital. The majority of the funds, 5 to 7, will be in funds covering earlier stage venture capital, so series A, B, so not seed, but early stage, whereby let's say the technology is proven, but just needs scaling. And then 1 to 3 fund commitments will go into growth and buyout. So later stage, really de-risked. Those companies are proven, just need scaling. We have the flexibility to do up to 3 direct investments as part of the portfolio, but only maxed out at 5% of the overall fund. And from a geographic point of view, we expect to deploy it approximately 50-50 between Europe and the US. The opportunity size in the US is slightly larger, so it could end up being 45-55, but directionally it's 50-50. And from a sector point of view, we aim to really touch on all the verticals. So we select funds across energy, industry, food and agri, transportation, buildings. It should really be the total market coverage by investing in our fund. So why 7 to 10 commitments? That's not an arbitrary number. If you invest in more than 7 funds as part of a fund of funds, the risk of losing capital is significantly reduced. So on this slide, you see what is the risk of losing capital if you, on the left-hand side, just invest in 1 private market funds. That's 24% based on historical data. Now, if you make a bucket of 3 funds, this already drops from 24 to 9%. And if you continue this path, if you select 7 or more funds, we're talking about the risk of losing capital of below 1.5%. So we think diversification, therefore, is critical and beneficial for our investors. Now, if you look at the pipeline of funds, it's very attractive. We have approximately 10 funds in active diligence. Most of these are actually 2nd generation or 3rd generation funds, so no first-time teams in the current pipeline. And it's a very healthy mix between early stage seed funds all the way up to growth equity funds right now, and also balanced between Europe and North America. So the ones that are near-term candidates fit very well in how we try to build the portfolio. So we're very excited about the pipeline, and we look forward to announcing any new fund commitments once we have finalized our diligence.
Cool. Then finally, a few words on how does this thing work? So the main thing about carbon equity is that we aggregate a lot of relatively small investment amounts to be able to write large underlying checks to top climate venture capital and private equity funds. And the main result of this is that you invest in a portfolio, as we mentioned, of 150 up to, let's say, 200 early stage, mid stage, and late stage climate technology companies all across the spectrum, from hardware to software, deep tech type companies. If we skip to the next slide, maybe cool to highlight a few examples of our current portfolios of the current funds. One of the companies, for example, is Sublime Systems, and Sublime, they electrify cement production. So they use a mix of renewables and chemical storage to create carbon-free cement. So solving the huge problem of carbon emissions from cement, which amounts to approximately 7% of global carbon emissions. Another favorite example of mine, the company called Transera, and what they do, they've developed hyper-efficient air conditioning, which is up to 5 times more efficient than current air conditioning technologies. which is super crucial because by 2050, we'll be adding another 1 billion air conditioners on the planet. So efficiency will be super critical. Or a deep tech company such as electric hydrogen. And what electric hydrogen does, they design and build low-cost, high-efficiency green hydrogen systems, which can help decarbonize very heavy industries such as ammonia and steel. So you can see the range of types of solutions that you will be investing in through carbon equity. We would like to keep you updated on every step of the way. We very recently launched a first version of the app where you can now see exactly what companies you're invested in, what they do, what impact they have, and we will soon be adding a news feed so that you can follow daily, weekly updates on what's happening within your portfolio. We will be inviting you for regular webinars. The next webinar will be a panel discussion with several US and European investors talking about the current climate investing market, addressing the question, is now a good time to invest in climate tech or not? So you will receive almost monthly invites for webinars, and once or twice a year, we host climate investing drinks in various cities where we are active, April 20 in Ghent, and hopefully in June in Amsterdam again. Then finally, if you're interested to know more after this, what's to do? First of all, I recommend to book a quick call. You can do that through the website or through email and talk to one of the people on our team to learn more and ask your questions, answer any questions you may still have on this fund. We are doing a closing in the coming 2 months. So if you want to be part of the first close with the 10% first close discount, important to act within the coming weeks. If you haven't received the information already, I think there will be a link in the follow-up email. You can request access to the data room and make sure you read up on all of the materials that are to read on the fund. Then you can just request your allocation online on the website and formally onboard. You'll go through a 10 to 15 minute onboarding process, and then through the app, stay posted on what's happening within the fund. Cool. Thank you very much for attending. Now let's go to the Q&A. Maybe Liza, you can stop the screen share. Excellent. Cool. So I see a couple of questions. First, what would be the right investment strategy if assuming that climate tech is the next hype? We addressed that question already. What are the key lessons you have learned from the first fund? A question from Anthony Wiebe. Could you answer that question?
Yeah, interesting question. A bit early. We're still deploying that fund. We expect to make 1 or 2 commitments from Fund 1. But I think in general, what might have surprised us is really the opportunity set in the US. That is much larger than Europe. So selecting funds, therefore, in the US has been a little bit easier. And at the start of the fund, we were a little bit overweight US, and we had to take more time in Europe in really scratching the surface, finding the right opportunity. So the second half of last year, we really shifted our attention to Europe, spent more time there to really better understand all the opportunities there. And luckily, we found a few interesting ones. So we expect to announce more European funds as part of our Fund 1 over the next few weeks. But I think that is really a lesson learned, and I think we will have to continue spend more time in Europe to find attractive opportunities.
Cool. Lisa, question for you. I guess a more personal question. What climate technology innovations are you personally most excited about? And what would you like to see more of in the next 5 years?
That's a great question. It's a question I typically also ask the funds when we talk to them to get their view. The technology that I'm currently most excited about is thermal energy storage. There's one company in the portfolio of Fund 1 in their Rondo Energy. And actually yesterday we got an update from the GP. So what they're doing is actually low tech in some way. They take a huge pile of bricks, they put it in a really well insulated room, And then they use something close to what you use to toast your bread to heat those bricks with green electricity when we have too much of it. Those bricks can be heated up to 1800 degrees Celsius. And that temperature is hot enough, not only, well, for all sorts of industrial applications. So not only for, let's say, sterilizing food, for which we need to go to 100 something degrees, but we can actually use that temperature for ultra high temperature processes like steel making, concrete making, and do deep decarbonization. And what I think is so exciting is that you're taking that problem of intermittency of green energy, where the sun doesn't always shine, the wind doesn't always blow. You turn that into an advantage, because when there's too much sun and too much wind, it's super cheap. You can buy green electricity really cheap, then store it, and even also use it to go from electricity to heat, which sometimes is quite challenging. And then the second part of the question, what I'd like to see more of in the next 5 years, I think geothermal energy is something that's hugely, well, the potential cannot be overestimated, I think. And so far, investments into this space have been limited. So the Earth is really hot in its interior. And if we can effectively tap into that heat, it's a virtual endless energy supply. There's a few companies working on how to make that drilling better, more efficient, to make sure that we can access it cost effectively. But there, I think we can do much more.
Cool, thank you. Important question from Sarah. Why are you not investing in funds in emerging markets? Lots of innovations there too. And I totally agree. Sarah, maybe to clarify, so the scope of this climate tech portfolio fund 2 is not yet in emerging markets. Carbon equity generally, I hope in the future years, will also have emerging market strategies and also potentially emerging manager strategies. So for us, this is also a bit of a beachhead, very clear focus portfolio, US, Europe, but we are definitely open to launching such strategies in the future, because I mean, I totally agree that there's a lot of interesting innovations happening in emerging markets, plus decarbonization in emerging markets is absolutely crucial, because otherwise we're not getting anywhere with the global net zero emissions. So there will definitely be other strategies to come, which are not yet included in the scope of this fund. Cool. Let me just briefly check on the time and see how many more questions we have. All right. Okay. I have a new question coming in. All right. We have a question from Soline. A great concept. Thank you for an insightful presentation. 3 questions. Is carbon equity classified as SFDR 8 or Article 8 or 9? Important question for Liza. How do you make sure VCPE funds are not greenwashing? And are you looking at water funds as a subsector? So Liza, maybe you can take that one.
Yeah, great question. So the portfolio fund is classified as Article 8. So the SFDR, Sustainable Finance Disclosure Regulation, for those of you who don't know it, it's a regulation from the European Union. And depending on what claims you might make about how sustainable your fund is, you need to report different things. So really, it's a reporting tool. The reason that so it goes from Article 6, which is no sustainability, Article 8, some sustainability, Article 9, fully sustainability. Even though our portfolio could easily be Article 9, we're reporting as Article 8. And the reason is because we're selecting funds also in North America, some of which won't report under SFDR at all. So we won't get the required data to report on Article 9. But rest assured, the portfolio is really climate impact, full focus. Then the second question, how do we make sure the funds are not greenwashing? I think with the climate scorecard, we try to give you some insight into how we select on impact, to make sure that we select fund managers that have fully integrated impact into their entire investment decision-making process, their organization, their mandate. So that's where we really dive deep on those funds. And then we also look at their portfolios, the current portfolios and the past portfolios, to make sure that the investments they've done are really impact investments. And then finally, water funds is a really interesting topic. We're focusing, or at least we're talking to a lot of them, because we're quite keen. There's exciting work there. Typically with water funds, you see that they're not only focused on decarbonization, but also on a lot of other impact themes. Some of those are less relevant for carbon equity, And typically, so far, we haven't seen enough decarbonization focus within those funds. But we're keeping our eye out.
Cool. All right. There are no new questions that came in. So then I imagine all of your questions have been answered just in time. Should there be questions that, Ruben, the question on Article 8, not 9, was just answered by Liza. The reason is because we also have US funds in the mix that don't report on SFDR. So we really make sure that the funds that we select are truly globally the very best in class climate impacts we can find. So if I can assure you of one thing, is that we're absolutely uncompromising when it comes to the quality and intentionality of impact that we want to see with the funds. But we will not report ourselves as a Fund 9 if we cannot gather all of the data required to do so, because that would not be an authentic thing to do. Hence the choice for an Article 8 registration. But I doubt you can find a more climate impactful fund than honestly than carbon equity. Cool. If there are any further questions that you have, we'd be delighted to answer them. As mentioned, kindly reach out through email, the website, or LinkedIn. Ask us any questions. Set up a call with our investment team or investor solutions team. We'd love to.
Jacqueline,
yeah.
Before you wrap up, one more question came in, and we do have 3 more minutes, so we might as well tackle it.
All right.
Wiebe, for you. Will you eventually also select first-time managers and support them with our expertise?
Yeah, it's a good question, because the pipeline didn't show any first-time funds, but our first fund actually included first-time funds as well. So it's not necessarily no, but the bar is just very high. So for example, the Energy Impact Partners Frontier Fund was the first fund that's being invested by that team of EIP. But we got comfortable there because they are part of a larger organization that bring a lot of institutional and professional setup and also expertise from the other investment partners from the other teams. So as part of a different firm, there we got comfortable. And similarly, we also raised a fund for 2150 in Europe. There was also a first-time team, but also part of a larger organization within the real estate space, NREP. Very similar to EIP, that team brings a deep prior experience in venture capital, but it's still a first-time team. They have not invested together, but there were sufficient mitigants for us to still back them. So it's not necessarily a no, but we're just very careful and mindful of stepping into first-time funds.
Yeah, cool.
And then very quickly, one more question came in the chat. Would love to answer. Someone at Douwen is asking, will we ever consider engaging with funds and potentially even divest if the investment that they're doing, we don't support them? It's a good question. We do have divestment as an ultimate consequence, and we engage regularly with all our funds. The specific example that Douwen is referring to is South Pole. It's a company that in the last few months hit the news in a negative way, and it's a portfolio company of Lightrock that's part of our first portfolio fund. In this case, we did engage to ask for further information. We spent a lot of time understanding what really happened. South Pole sells carbon credits. Some of those credits turned out that they overestimated the impact of some of the projects that they've done. Hence, they've sold more credits than they realistically created. Diving deep, understanding through the GP what happened there, we came to the conclusion that we understand why it happened and they're mediating the situation sufficiently. So for now, no reason to divest, but definitely something that we do. And ultimately, it could be an option.
Yeah. Cool. All right. Then kindly ask any remaining questions through email. Thank you very much for your attention, for being here. We hope to see you back in the fund and at future webinars and carbon equity events. Thank you very much and have a great rest of your day.